The Bank of England holds rates and flags danger in the rising oil price. The Bank of England is worried, among other things, that the conflict between Israel and Iran could lead to another energy price rise in an economy that already has some of the most expensive energy in Europe. British inflation did cool slightly in May, but policymakers sounded very cautious about cutting rates. Hetal Mehta is chief economist at St James's Place. Hetal, nobody expected the bank to move today, but what did you make of the commentary we've seen?
So I think the commentary is in line with the cooling of the economy, whether it's the labour market, also the growth numbers. I think the previous meeting was almost taken perhaps too hawkishly. The Bank of England maybe now just trying to pull some of that back, acknowledging the risks that we're seeing further out. And I think it lays the foundation for the gradual cuts that we've been expecting, and they've been flagging for some time.
We expected a 7-2 split in favour of holding. They've been slightly more dovish. We've seen 6-3. Is there any surprise there?
I think there is. I think Dave Ramsden joining the ranks of the dovish voters was a bit of a surprise. Obviously, they're all independent members, and most people widely expecting the majority shift to a cut in August. But I think coming at this juncture was maybe a little bit earlier than people expected.
The bank warned, as you mentioned, of softening in the labour market. How worried should policymakers be?
So it's worth remembering that the labour market is still in relatively good shape. Unemployment is quite low, but we have seen this kind of steady trickle in terms of the payrolls measure of employment starting to show some negativity, and that could snowball. So I think it's right that policymakers are concerned, but the starting point is actually relatively good.
The Fed yesterday also seemed to want to dial back expectations of cuts anytime soon. What do you make of the differences in the tone being set by the two central banks?
So I think the fundamental forces that are buffeting both economies are quite different. So in the US, obviously, we have the tariff effect, which would in time be quite inflationary as those effective tariffs start to filter through to the system. We almost have the opposite effect in terms of trade on the countries who are on the receiving end of those tariffs. It should be disinflationary, weaker for growth. But we do also have to bear in mind the recent escalation in Middle East tensions and the oil price spike, which the UK is probably more sensitive to in terms of the oil and the pass-through. So there's obviously some big differences, but I think both are actually trying to kind of manage those idiosyncratic risks currently in play.
Given that balancing act, do you think markets should be pricing in perhaps more cuts from the Bank of England this year than they are at the moment?
It's hard to say. The amount of volatility we've had in rate expectations in the last few months has been quite pronounced, especially with the tariff ups and downs. And it's worth remembering that rates markets are often, quite synchronized. So what happens in the US inevitably does feed through into both the UK and the Eurozone. So I think for the time being, this idea of cautious gradual cuts is probably appropriate because we still do have sticky inflation. Inflation is coming down gradually, but it's still not where the central bank would want it. I think cutting too aggressively risks stoking those inflation expectations, and something the Bank of England, for its kind of core mandate, cannot afford to let that happen.
What has the market made of today's decision, especially in sterling?
So I think the initial reaction was a slight weakening because of that dovish move that was unexpected, but it's in the grand scheme of things, it seems to have been a relatively muted reaction.
That was Hetal Mehta of St James's Place. Don't forget, you can watch more videos on Reuters.com.